The bond market is breaking. Not with headlines, not with panic, but with something far more dangerous. A silent structural collapse that most people will never see coming until it detonates across every corner of the financial system. Right now, at this very moment, the world's largest and most important financial market is experiencing a liquidity crisis that analysts compare to the early warning signs of March 2020. The U.S. Treasury market, $30 trillion in outstanding debt, $900 billion in daily transactions. The foundation upon which every interest rate, every mortgage, every corporate bond, every retirement account is built. And it's deteriorating at a pace that has fixed-income traders and central bankers quietly terrified. In April 2025, something broke. Treasury yields spiked from under 4% to 4.5% in just 4 days. Market depth, the amount of bonds available to buy or sell at any given moment, collapsed by magnitudes not seen since the pandemic crisis. The spread between Treasury yields and interest rate swaps widened sharply, a technical signal that screams stress in the plumbing of finance. Dealers, the market makers who are supposed to keep everything flowing, pulled back. Bid-ask spreads, the cost of trading, exploded. For a brief moment, the most liquid market on Earth became illiquid. Most people missed it. The stock market kept climbing. Crypto kept pumping. Life went on. But in the sealed conference rooms of the Federal Reserve Bank of New York and the Treasury Department, alarms were ringing. Because what happened in April wasn't a one-time event. It was a symptom, a warning sign of systemic fragility that has been building for years, hidden beneath the surface of record stock prices and seemingly calm markets. Here's what very few people understand. The Treasury market isn't just big, it's the collateral for everything else. Banks use treasuries to meet capital requirements. Hedge funds use treasuries as collateral to borrow hundreds of billions in the repo market. Pension funds, insurance companies, foreign governments, they all depend on being able to buy and sell treasuries instantly, at predictable prices, in virtually unlimited size. When that ability starts to crack, when liquidity begins to evaporate, the contagion doesn't stay contained. It spreads like a virus through every interconnected market on the planet. The Federal Reserve Bank of New York published data in late 2025 showing that Treasury market liquidity, while improved from April's lows, remains fragile and highly sensitive to volatility. The price impact of trades, meaning how much a single large order moves the market, is elevated. Order book depth, the cushion of buy and sell orders waiting to absorb trades, is thin by historical standards. And this is happening at the exact moment when the Treasury Department is issuing record amounts of debt to finance persistent federal deficits. Think about that for a second. The government needs to sell more bonds than ever before, but the market's ability to absorb those bonds is weaker than it's been in years. Supply is surging, demand is fragile, and the intermediaries who connect buyers and sellers are facing constraints that didn't exist a decade ago. This is not a stable equilibrium. This is a pressure cooker. So what changed? Why is the most important market in the world struggling? The answer lies in a series of structural shifts that have been building since the global financial crisis of 2008. After that crisis, regulators came down hard on banks. Capital requirements went up, leverage limits tightened. The goal was noble: make banks safer, prevent another Lehman Brothers, but there was a side effect that nobody fully anticipated. Primary dealers, the 24 financial institutions that are obligated to make markets in treasuries and participate in every treasury auction, are mostly bank-affiliated, and those new regulations hit them hard. The supplementary leverage ratio, a rule designed to cap bank balance sheets, became a binding constraint. Research from the Federal Reserve Bank of Boston quantifies the impact. When a bank's leverage ratio tightens by just 1 percentage point, the affiliated primary dealer reduces its treasury holdings by over 9%. Turnover drops, bid-ask spreads widen. The dealer becomes less able to provide liquidity. Multiply that across the system, and you have a market that looks healthy on the surface, but lacks resilience underneath. At the same time, the composition of treasury holders has shifted in a way that makes the market more volatile. Foreign central banks, historically the most stable, price-insensitive buyers of U.S. debt, now hold a smaller share than they used to. Their place has been taken by hedge funds, by leveraged relative value traders, by players who are exquisitely sensitive to price and who can vanish in a heartbeat when volatility spikes. These are not buy and hold investors. These are hot money. And here's where it gets truly dangerous. A massive portion of hedge fund treasury activity is driven by a single trade. The cash futures basis trade. It sounds technical. It sounds boring. But the Office of Financial Research estimates this trade has notional exposures exceeding $1 trillion. Here's how it works. A hedge fund buys a treasury bond in the cash market. It finances that purchase in the repo market, borrowing against the bond overnight at cheap rates. Then it sells treasury futures, locking in a tiny profit from the price difference between the cash bond and the futures contract. The returns are small, often just a few basis points. So the fund levers up 20 times, 30 times, sometimes 50 times to make the trade worthwhile. This trade is everywhere. Citadel runs it. Millennium runs it. Every major multi-strategy hedge fund has dedicated teams whose only job is to harvest the basis. And when markets are calm, when repo funding is cheap and plentiful, it works beautifully. The basis traders actually provide liquidity to the market. They absorb treasuries that others want to sell. They smooth out price discrepancies. They're like the oil in the engine. But when volatility hits, when repo rates spike, or when margin requirements suddenly increase, the basis trade flips from stabilizer to destabilizer in the blink of an eye. Hedge funds face margin calls on their futures positions. Banks that provide repo financing demand more collateral or higher rates. The hedge funds have no choice. They have to unwind. They have to sell treasuries into a falling market, and because they're levered to the hilt, even a small move can force liquidations in the tens of billions. This is exactly what happened in March 2020. The Office of Financial Research data shows that hedge funds sold roughly $100 billion in treasuries during the worst 2 weeks of the pandemic market meltdown. That selling, combined with mutual funds dumping bonds to meet redemptions and foreign institutions liquidating positions, overwhelmed dealer capacity. The market seized up. Bid-ask spreads on off-the-run securities, older bonds that aren't actively traded, exploded to levels never seen before. Prices cratered, even as investors were supposedly fleeing to safety. The Federal Reserve had to step in with unlimited bond purchases, essentially becoming the buyer of last resort, to prevent a complete collapse. Fast forward to today, and the basis trade is bigger than it was before the pandemic. Form PF data collected by the Securities and Exchange Commission, analyzed by the Federal Reserve, shows that hedge fund holdings of Treasury securities have grown by over $1 trillion since 2022. The vast majority of that growth is driven by Cayman Islands domiciled funds. The offshore vehicles that multi-strategy hedge funds use for their basis trading operations, repo borrowing by hedge funds doubled between late 2022 and late 2024, reaching $2.5 trillion. That is not a hedge against risk. That is a bet on stability. That is a leveraged wager that nothing will break. Here's the terrifying part. Market participants and regulators know this is fragile. The Commodity Futures Trading Commission's Market Risk Advisory Committee published a report in December 2020 for warning about the systemic risks of the basis trade. The Financial Stability Oversight Council has it on their radar. The Federal Reserve includes it in every financial stability report. Everyone sees the risk, but nobody has done anything meaningful to reduce it. Why? Because unwinding a $1 trillion leveraged trade without causing the very crisis you're trying to prevent is nearly impossible. And because the political and lobbying pressure from the firms running these trades is immense, they argue that they provide liquidity, that they make markets more efficient, that regulation would hurt Treasury market functioning, and to some extent, they're right. But they're also sitting on a powder keg. Meanwhile, the primary dealers, who are supposed to be the shock absorbers, are running out of capacity. Balance sheet data from the largest bank holding companies, compiled by the Bank Policy Institute, shows that U.S. Treasury holdings as a percentage of total bank assets have tripled since 2013, from 3% to 11%. Banks are stuffed with treasuries. They're holding them to meet liquidity requirements, but their ability to actively intermediate, to take on additional inventory when the market needs it, is constrained. The supplementary leverage ratio, the risk-based capital rules, the global systemically important bank surcharges, all of these regulations act as a ceiling on how much more Treasury exposure dealers can take on. The numbers tell the story. As of mid-2024, the Federal Reserve estimated that if primary dealers used every bit of their remaining balance sheet capacity for Treasury intermediation, they could expand those activities by over 300%. That sounds like a lot of headroom, but here's the catch. That calculation assumes nothing else goes wrong. It assumes banks don't face deposit outflows, loan demand surges, or stress in other parts of their business. In March 2020, bank balance sheets expanded for reasons that had nothing to do with treasuries. Credit lines got drawn down. Loans ballooned. Suddenly, there was no room left for dealer inventory, and the same thing could happen again. The auction data adds another layer of concern. Treasury auctions are how the government borrows money. Every week, the Treasury Department sells new bonds to fund the deficit. The bid-to-cover ratio, which measures total demand relative to the amount being sold, has been range-bound but occasionally weak. The tail? The difference between the auction yield and the pre-auction when-issued yield has been positive in several recent auctions, indicating weaker than expected demand. Primary dealers, who are obligated to bid and act as buyers of last resort, have been taking a smaller share of auctions in recent years. On one hand, that's a sign that other investors are participating. On the other hand, it means the safety net is thinner when things go bad. And here's the brutal irony. The very regulations designed to make the financial system safer have made the Treasury market more vulnerable. Higher capital requirements for banks mean dealers can't warehouse as much inventory. Post-crisis reforms pushed more trading onto electronic platforms, which are faster and more efficient in normal times, but can evaporate in a crisis when high-frequency traders pull back. The shift from traditional dealers with deep pockets to principal trading firms with thin capital bases has made the market more fragile. These were all reasonable policy choices at the time, but they have consequences, and those consequences are becoming visible. So here we are. A Treasury market that looks calm on most days. Bid-ask spreads are tight, auctions clear, life goes on. But underneath, the structure is brittle. Dealer capacity is stretched. Hedge fund leverage is massive. Foreign buyer demand is less reliable. Issuance is at record levels. And volatility, when it comes, tends to come fast and hard. History shows that these conditions don't resolve themselves peacefully. They resolve with a crisis. The question isn't whether the Treasury market will face another stress event. The question is what happens when it does. Because the plumbing that broke in March 2020 has not been fundamentally fixed. In some ways, it's more vulnerable now than it was then. And the next time it breaks, the consequences won't stay contained in the bond market. Start with repo markets. The repurchase agreement market is where the basis trade gets its leverage. It's where dealers finance their inventory. It's where money market funds park their cash overnight. $4 trillion in Treasury repo transactions happen every single day. The entire system runs on the assumption that treasuries are the safest. Most liquid collateral in the world, that you can always borrow against them at predictable rates. But what happens when that assumption breaks? In March 2020, repo rates spiked. The spread between repo rates and risk-free rates widened to levels that suggested severe funding stress. Hedge funds running the basis trade couldn't roll their overnight financing at reasonable rates. Some faced the prospect of being unable to finance their positions at all. That's when the forced selling began. And it wasn't just the basis traders. Cash-rich investors like money market funds pulled back from lending in repo because they weren't sure their counterparties could survive. The market seized. The Federal Reserve had to open emergency lending facilities, had to promise unlimited intervention just to keep the repo market functioning. Now imagine that happening again, but with even larger basis positions, even more leverage, and even less dealer capacity to absorb the shock. The New York Fed has built a standing repo facility, a permanent backstop that offers overnight funding to primary dealers and money market funds. Officials argue this changes the game, that it prevents the kind of funding squeeze that forced liquidations in 2020. And maybe they're right, but the facility has limits. It's capped at $500 billion in total lending. If the next crisis requires more than that, if the panic spreads faster than the Fed can respond, the backstop might not be enough. The contagion pathways from Treasury market stress are well established. First, corporate funding markets. Corporate bonds are priced off the Treasury curve. When Treasury yields spike due to illiquidity rather than fundamentals, corporate borrowing costs rise even if nothing has changed in the underlying economy. Companies that need to refinance debt or raise capital face higher rates. Investment gets delayed. Hiring slows. This isn't theory. It's what happened in 2020, and it's what economic research consistently shows. Second, mortgage markets. The 30-year fixed mortgage rate is tied to the 10-year Treasury yield. When Treasury market dysfunction pushes yields higher, mortgage rates follow. Suddenly, homebuyers can't afford the houses they were shopping for. Refinancing activity collapses. Home sales drop. And because residential real estate is the largest asset class for most American households, the wealth effect feeds back into consumer spending. The economy slows, not because anything fundamental changed, but because a technical breakdown in the bond market raised borrowing costs. Third, global collateral chains. U.S. Treasuries aren't just used in the United States. They're the global reserve asset. Banks worldwide hold them to meet capital requirements. Central banks hold them as reserves. International investors use them as collateral for cross-border transactions. When Treasury market liquidity deteriorates, it ripples through foreign exchange markets, through overseas sovereign bond markets, through emerging market debt. The European Central Bank has documented this. Research shows that Treasury market stress amplifies the transmission of U.S. monetary policy shocks to other advanced economies. When U.S. Treasuries become harder to trade, global financial conditions tighten. Fourth, leveraged finance and derivatives. The basis trade is just one of many strategies that depend on stable Treasury markets. Interest rate swaps, the derivatives that companies and banks use to hedge interest rate risk, are priced relative to Treasuries. Credit default swaps, the insurance contracts on corporate and sovereign debt, use Treasuries as the benchmark risk-free rate. When Treasury market functioning degrades, uncertainty spreads into all of these derivative markets. Pricing becomes erratic. Hedges that were supposed to protect investors stop working. And in a world where notional derivative exposures run into the hundreds of trillions of dollars, even small disruptions can have outsized effects. The regulatory response so far has been incremental at best. The Securities and Exchange Commission finalized rules in 2024 to expand central clearing of Treasury securities. The idea is that by routing more transactions through a central clearinghouse, counterparty risk gets mutualized and the system becomes more resilient. Implementation deadlines are rolling out through 2026. It's a step in the right direction. But clearing comes with costs. It requires more collateral. It imposes operational burdens. And some market participants worry that mandating clearing could actually reduce liquidity in the short term by forcing smaller players out of the market. The other major regulatory focus has been on data collection. The Federal Reserve and the Treasury Department have been gathering more granular information on primary dealer positions, on hedge fund repo activity, on the size and structure of the basis trade. The Office of Financial Research launched a hedge fund monitor that makes aggregated form PF data available to the public. This is useful for monitoring risks, but monitoring isn't the same as mitigating. Policymakers can see the leverage building. They can see the concentration of risk, but the tools to actually reduce that leverage without triggering a crisis are limited. There have been calls to modify the supplementary leverage ratio to exempt Treasuries from the calculation so that dealers have more balance sheet capacity. Federal Reserve Chair Powell has expressed support for this in congressional testimony. The argument is that Treasuries are the safest assets. They shouldn't consume balance sheet in the same way that risky loans do, but this is politically contentious. Critics argue that exempting Treasuries would allow banks to take on more leverage, that it undermines post-crisis reforms, that it creates moral hazard. The debate has dragged on for years with no resolution. Meanwhile, the clock is ticking. Treasury issuance isn't slowing down. The Congressional Budget Office projects deficits in the trillions for years to come. Every dollar of deficit has to be financed with a Treasury bond, and every bond has to be absorbed by the market. As long as demand holds up, as long as foreign investors keep buying, as long as domestic institutions need Treasuries for regulatory purposes, the system can keep going. But demand is not infinite, and at some point the market will test the boundaries of what dealers and investors can absorb. History offers a guide. Every major financial crisis of the past 30 years has involved a moment when a supposedly safe, liquid market suddenly wasn't. Long-term capital management in 1998, the repo market in 2007, the mortgage-backed securities market in 2008, the Treasury market in March 2020, the pattern is always the same. Leverage builds in a trade that looks safe, because it's hedged, because it's arbitrage, because it's backed by high-quality collateral. Risk managers convince themselves that the worst-case scenario is manageable. And then something breaks. Volatility spikes. Funding evaporates. Forced selling begins, and what looked like a diversified, hedged, safe position turns into a liquidation spiral that no one can stop. The basis trade today has all the hallmarks. It's massive, it's leveraged, it's dependent on continuous access to repo financing, it's concentrated in a relatively small number of large hedge funds, and it's inherently procyclical, meaning it amplifies whatever stress hits the market. When Treasury prices fall and volatility rises, the trade becomes less profitable and more risky at the same time. Margins increase, funding costs rise, returns compress. Funds face a choice: add more capital, which dilutes returns, or reduce positions, which means selling into a weak market. Most choose to reduce, and when everyone reduces at once, you get March 2020 all over again. The defenders of the trade make valid points. They argue that basis traders provide liquidity by buying bonds that others want to sell. They argue that the trade is fundamentally hedged, that losses are limited. They argue that higher margins and better risk management have made the trade safer than it was in 2020, and there's some truth to all of that. But there's also a deeper problem. The trade works because of systemic stability. It depends on markets functioning normally, on repo funding being available, on futures and cash prices converging. The moment any of those assumptions fails, the trade becomes a source of instability rather than a source of liquidity. So what's the end game? In the optimistic scenario, policymakers muddle through. The standing repo facility prevents funding crises. Expanded central clearing makes the system more resilient. Dealer balance sheet constraints gradually ease as regulations are refined. The Treasury market experiences occasional bouts of volatility, but nothing breaks catastrophically. Issuance is absorbed. Auctions clear. Life goes on. This is possible, but it requires everything to go right. It requires no external shocks, no policy mistakes, no sudden loss of confidence. In the pessimistic scenario, the vulnerabilities that analysts have been warning about for years finally materialize. A geopolitical crisis, a policy blunder, a sudden shift in inflation expectations. Something triggers a spike in Treasury yields. Volatility explodes. Hedge funds running the basis trade face margin calls and funding stress. They start to unwind. Dealers, already at the limits of their balance sheet capacity, can't step in to absorb the selling. Bid-ask spreads widen. Market depth evaporates. The price moves become self-reinforcing. More stress leads to more deleveraging, leads to more stress. The Federal Reserve is forced to intervene again, bigger and faster than in 2020, buying treasuries outright to stabilize the market. But this time, the consequences don't stop there. Corporate bond markets freeze. Mortgage rates spike. Stock markets tank as investors flee to cash. Credit spreads blow out. Leveraged loans and high-yield bonds, which depend on functioning capital markets, see their valuations collapse. Private equity funds that planned to refinance debt find themselves unable to roll over maturing obligations. Companies cut investment in hiring, the real economy starts to contract. And suddenly, a technical breakdown in the plumbing of the Treasury market has become a full-blown financial crisis. This isn't speculation, this isn't fear-mongering, this is the logical endpoint of the structural vulnerabilities that exist today. Every piece of the puzzle is visible. Dealer constraints are documented. Hedge fund leverage is tracked. Repo market dependencies are known. The only question is timing. The only question is what sparks the next unraveling. And here's the most unsettling part. Even if policymakers understand the risks, even if they're monitoring the situation closely, there may not be a way to diffuse it without triggering the very crisis they're trying to avoid. Forcing hedge funds to unwind the basis trade would create selling pressure. Exempting treasuries from leverage ratio calculations might encourage even more risk-taking. Expanding central clearing imposes costs that could drive some participants out of the market. Every solution has trade-offs. Every intervention has side effects. The system is trapped in a kind of equilibrium where the status quo is fragile, but any attempt to change it risks making things worse. This is what a silent breakdown looks like, not a single dramatic event. Not a Lehman Brothers moment where everyone sees the crisis at once, but a slow accumulation of stress, a gradual erosion of resilience, a market that functions most of the time but becomes dangerously unstable whenever volatility strikes. The Treasury market in 2025 looks calm on the surface, but beneath that calm is a structure that has been fundamentally weakened by a decade of regulatory changes, record issuance, shifting investor bases, and the buildup of massive leveraged positions. The next time markets get turbulent, the next time volatility spikes, the next time funding conditions tighten, we'll find out whether the system can hold. We'll find out whether the standing repo facility is enough. We'll find out whether dealers have the capacity to step in. We'll find out whether hedge funds can unwind positions in an orderly way. And if the answer to any of those questions is no, if the plumbing fails the way it failed in March 2020, the consequences won't stay contained. They'll ripple through repo markets, through corporate debt, through mortgages, through global finance. Because in the modern financial system, everything is connected, and the Treasury market is the connection point for everything. So pay attention, not to the headlines, not to the stock market hitting new highs. Pay attention to the quiet indicators: order book depth, bid-ask spreads, auction tails, primary dealer positioning, hedge fund, repo borrowing. These are the warning signs. These are the cracks forming in the foundation. And when the foundation breaks, the whole structure comes down.